Yeah, so what we do is we have a framework, and we start from kind of the assumption that, so we have a qualitative checklist, just 5 points, kind of, what's the moat, what's the vector of the moat, and a few other things. It's nothing rocket science. And then we obviously have some expectation of what kind of returns the business could generate, right? What's the difference between what we think it's worth and the stock price today? And then you marry those two things. And what we do is we just say, okay, so if it's a perfect business, it scores perfectly on our checklist, and it has a very high expected return, then our hurdle rate is 15%, and that might be a very high expected return might be 30%. Then that gets a 15% position, right? So that's a max position for us. And anything worse than that, we kind of discount from there, right? And so a business with, say, a 20% expected return, but that's also perfect, might be a 12% position. A business that has a very high expected return but doesn't score well on the checklist, that's also maybe a 10% position, right? And the point being that none of this is perfect, but it gives you a framework, right? Because then you can look at the portfolio as prices move around and say, hey, these two companies, we expect about the same return for them. They're kind of similar on the quality score. Why is one 12% and one 7? Huh, right? It just kind of forces the question, right? And forces you to be consistent around how you think about businesses. And okay, you can't capture everything in a DCF. You can't capture everything in a quality firm. There's always going to be, exogenous factors, new research that you're doing, whatever, that might not be incorporated yet, but at least gives you a starting point that I think is way better than gut feel. Around kind of like why do we size things the way we do? In terms of how we get there, we don't scale into things. Like the way I think about it is if you do the work, you understand the business, and you make the decision, right? And if things change, the price goes down a bunch, or you discover new information that makes it worth more, then you change your position size. But I don't really understand the idea of kind of scaling into a position deliberately. I mean, like, starting at 6 because it's only a little bit above your hurdle rate, and then buying more when the price goes down, well, that's rational. But you go into it saying this is a 6% position, and then information changes, and the information is the stock price going down. I've never really understood why people say, yeah, we kind of scale into things, even if things don't change, right? Like if you've done the work and you're committing the capital, commit the capital. I don't know, that's just me.